Welcome to the video. Today we'll reveal a critical but often overlooked risk when rolling over retirement accounts. Misclassifying designated Roth 401k dollars during a move into a solo 401k. We will explain what can go wrong, how to prevent errors, how to fix them if they happen, and when and how to escalate complaints. Let's begin. Here is today's roadmap. First, we'll cover the risk in rollovers, then clarify the difference between Roth and pre-tax dollars and why they must remain segregated. Next, we'll provide a safe rollover checklist, followed by how to fix mistakes quickly. After that, we'll walk through escalation options with FINRA and the Department of Labor's EBSA. Finally, we'll wrap with key takeaways and a short quiz. To transition, let's expose the hidden risk. Many investors consolidate accounts by rolling an old 401k into a solo 401k. If Roth and pre-tax dollars are commingled or coded incorrectly, especially when the receiving plan lacks a Roth subaccount, the Roth funds can lose their tax-free character. That means unexpected taxes and penalties. Now let's clarify the mechanics. Next, here are the mechanics. Pre-tax 401k dollars are contributed before tax and are taxable upon distribution. Roth 401k dollars are after tax and potentially tax-free at qualified withdrawal if handled correctly. Critically, designated Roth 401k dollars must be rolled into a Roth destination. That means either a Roth subaccount within the receiving solo 401k or directly into a Roth IRA. If the receiving plan does not support Roth contributions and a Roth subaccount, you must send the Roth portion directly to a Roth IRA. Never allow defaults or ambiguous instructions that could place Roth funds into a pre-tax account. Now let's compare. Roth 401k contributions are after tax. Their growth may be tax-free if qualified. On rollover, they must go to a Roth destination, either a Roth subaccount in a solo 401k or a Roth IRA. Pre-tax dollars are contributed before tax and are taxable upon withdrawal. They must go into a pre-tax destination. Mixing these during a rollover leads to reclassification risk and potential taxation. This flowchart shows the correct decision path. First, identify the separate source balances, pre-tax and designated Roth. Then, determine whether the solo 401k has a Roth subaccount. If it does, route pre-tax funds to the pre-tax subaccount and Roth funds to the Roth subaccount via direct transfer. If it does not, route the pre-tax funds to the solo 401k pre-tax account and the Roth funds directly to a Roth IRA. In all cases, obtain written confirmation and the correct distribution and deposit codes for each leg to preserve tax status. Moving forward, here is a step-by-step checklist. 1. Confirm in writing that the solo 401k has a Roth subaccount. 2. Request a written breakdown from the source plan showing pre-tax and designated Roth amounts. 3. Use direct trustee-to-trustee transfers rather than checks payable to you. 4. Submit separate written instructions for each portion and refuse any default that would commingle assets. 5. Obtain confirmations showing each portion's destination and coding. 6. Retain all documents, including confirmations, plan descriptions, statements, and emails. 7. Verify that the receiving institution posted the funds exactly as instructed within 3 to 5 business days. Let's review the documentation to collect and why each item matters. The plan feature confirmation proves the receiving solo 401k can accept Roth dollars. The source plan breakdown shows the exact pre-tax and designated Roth amounts. Written instructions for separate transfers prevent commingling. Distribution confirmations and codes verify the correct outflow characterization. Receiving deposit confirmations prove proper arrival coding. Before and after statements validate balances. Email records provide evidence if escalation becomes necessary. This sequence diagram illustrates a common failure. The participant requests a rollover, but provides vague instructions. The source plan sends a single transfer without separating Roth and pre-tax. The receiving solo 401k lacks a Roth subaccount. The record keeper posts everything as pre-tax. As a result, the Roth status is effectively lost, making future growth taxable. Later, the participant discovers the problem and must attempt a corrective transfer to a Roth IRA or a proper Roth subaccount. Next, let's cover top failure points. Do not rely on verbal assurances. Insist on written confirmation. Do not assume your solo 401k includes a Roth feature. Never allow a combined transfer that mixes pre-tax and Roth portions. Review confirmations and postings within the first week. Do not wait until tax time. By then, correction becomes harder and potential penalties grow. Quiz time. Question: if your solo 401k does not have a Roth subaccount, where must your designated Roth 401k dollars go to preserve tax status? Options: A. The solo 401k pre-tax account. B. A traditional IRA. C. Directly into a Roth IRA via trustee-to-trustee transfer. D. Sent to you first and redeposited anywhere within 60 days. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Directly into a Roth IRA via a trustee-to-trustee transfer. Roth 401k dollars must go to a Roth destination. If your solo 401k lacks a Roth subaccount, sending the Roth portion directly to a Roth IRA preserves its tax-free character. Now, if an error has occurred, act quickly. Prioritize the tax fix rather than assigning blame. In writing, request a corrective transfer of the misclassified Roth dollars into a Roth IRA. Ask for corrected coding and confirmations for each leg of the transfer. Document timelines, names, and case numbers. Consult a tax professional or IRA attorney to determine proper reporting and potential relief options. This timeline emphasizes urgency. On day 0, you discover the error. Between days 1 and 3, you request written corrective action. By days 3 to 10, you verify postings and confirmations. During tax season, ensure Forms 1099-R and 5498 reflect the corrections. If the issue remains unresolved by your filing deadline, you may face penalties and need professional assistance to address reporting and any relief options. Transitioning to escalation. If you believe there was a breach of professional conduct or failure to act in your best interest, you can file complaints with FINRA for broker-dealer conduct and with the Department of Labor's Employee Benefits Security Administration for retirement plan asset issues. However, fix the tax classification problem first before shifting attention to complaints. Let's clarify roles. FINRA addresses broker-dealer conduct, representative behavior, and supervision failures. DOL's EBSA handles the mismanagement of retirement plan assets and rollover issues. Regulatory complaints rarely result in direct compensation for fees or opportunity costs. They primarily document failures. Practically speaking, most individuals save more by fixing the tax classification error quickly rather than pursuing small compensation over a long period. Comparing the two tracks, fixing the tax issue first preserves the Roth status, stops penalty exposure, and offers faster, more controllable steps with the highest impact on long-term outcomes. Pursuing complaints documents a firm's behavior and may prompt reviews, but offers a low probability of direct compensation and requires considerable time and effort. Second quiz question: true or false? Regulatory complaints to FINRA or DOL or EBSA commonly result in direct reimbursement for your time and opportunity costs. Options: A. True. B. False. You may pause the video now to consider. We will discuss the answer in the next section of the video. The correct answer is B. False. Regulatory complaints rarely result in direct reimbursement for fees or opportunity costs. They primarily document compliance failures. For most people, fixing the core tax classification error produces faster and more meaningful results. This pie chart suggests a practical allocation. Dedicate roughly 80% of your time to fixing the tax classification as quickly as possible, and around 20% to filing and following up on complaints. This reflects the typical payoff profile for most individuals. Before we conclude, an important disclaimer. This content is educational and not tax, legal, or investment advice. Consult a qualified CPA, IRA attorney, or fiduciary advisor for your specific situation. Tax rules change. Verify current guidance, for example, in IRS publications 560 and 590A. State taxes and plan documents vary, so always obtain confirmations in writing. Here are the key takeaways. 1. Separate Roth and pre-tax at every step. 2. If the solo 401k lacks a Roth feature, route Roth funds to a Roth IRA. 3. Get everything in writing and verify postings quickly. 4. Fix the tax issue first. Complaints rarely lead to direct compensation. 5. Maintain detailed records for both corrections and any escalations. To wrap up, misclassifying designated Roth 401k dollars can lead to unexpected taxes and penalties. Use a written, two-leg rollover, pre-tax to pre-tax, and Roth to Roth. If errors occur, prioritize corrective transfers into a Roth IRA. Escalate to FINRA or DOL/EBSA to document conduct while keeping expectations realistic. Above all, rely on documentation and tight timelines. Thanks for watching. If you found this helpful, please like the video, share it with someone who needs it, and subscribe for more. We would love to hear your questions and experiences in the comments.